Right now, there are over 150 massive cargo ships just sitting there.
Yeah, completely paralyzed.
Right, totally paralyzed in this narrow strip of water in the Middle East. And because those ships aren't moving, you're probably seeing your retirement account lose thousands of dollars.
It sounds kind of absurd on the surface, I know.
It really does.
But the financial data from the past few weeks, it illustrates this incredibly fragile chain of cause and effect.
Yeah.
It links global geography directly to your personal portfolio.
Exactly. And we have a massive stack of financial and economic reports from mid-March 2026 to go through. So our mission for this deep dive is to trace that exact domino effect for you.
Yeah, we really need to look at how the current conflict in the Middle East is, well, triggering these severe oil shocks.
And reviving that dreaded stagflation word, which nobody wants to hear.
Right, and forcing investors to fundamentally rewire where they park their money. The overarching theme in these reports is it's a sudden collision between geopolitical reality and financial assumptions.
Yeah, and to set the scene for you, we just have to establish the foundational facts strictly as they're reported in our sources, right? No taking political sides here.
Absolutely not. We're just looking at the data.
Right. So on February 28th, 2026, U.S. and Israeli strikes occurred in Iran, and the Pentagon has reportedly been preparing ground forces.
Yeah, those are the events on the ground.
And our focus today is strictly on how those geopolitical realities are basically rewriting the rules of the global economy. Yeah, let's unpack this.
So to understand what is happening to those numbers flashing red on a stock ticker, we really have to start with the physical movement of goods.
Like the actual physical stuff.
Exactly. You just cannot model financial markets right now without looking at the tangible supply chain.
We're shifting from the political headlines directly to the physical choke points. Because you can't understand the inflation data, at all, without looking at energy.
And energy is currently in a state of absolute shock.
Total shock. I mean, before these events, Brent crude oil had a relatively stable baseline of around $60 a barrel.
Which was manageable.
Right. Very manageable. But following the strikes, it spiked to $112, and it briefly neared $120 a barrel.
A doubling of the core energy input for the entire global economy in, a highly compressed time frame. That is a systemic shock.
It's massive.
And the data shows this isn't just speculative trading based on fear, It is driven by actual physical disruption.
Right, like the reports talking about Iraq.
Yes, our reports note Iraq declaring force majeure at foreign-operated oil fields.
And just for anyone who doesn't know, force majeure is like a legal maneuver, right?
Yeah, it allows them to pause contractual obligations due to extreme circumstances, which instantly pulls actual physical barrels of oil off the market.
It's just gone.
Gone. And we also had confirmed drone strikes hitting refineries in Kuwait, which degrades actual production capacity.
Which brings us to the Strait of Hormuz. I mean, the strait is always a known bottleneck, but right now, it's essentially a parking lot.
A very expensive parking lot.
Seriously. According to the sources, roughly 20% of all global oil and LNG normally transits through that specific waterway.
And LNG is liquefied natural gas, just to clarify.
Right, the supercooled fuel that powers municipal grids and heats homes around the world. So with over 150 ships just anchored and delayed.
It's just entirely backed up.
Yeah, it makes me think of closing the main toll booth on a massive 10-lane interstate. Like, the traffic doesn't just stop at the booth.
No, it backs up for miles.
Exactly, it backs up into the surrounding cities and paralyzes streets miles away.
I like that toll booth analogy. It captures the cascading nature of the delay perfectly.
Right.
Because when you have 20% of the world's core energy supply stuck behind a closed gate, the market immediately prices in the scarcity.
So tracing this back to you, the listener, how fast does a physical supply blockage on the literal other side of the world actually hit your wallet?
Well, what's fascinating here is the pass-through effect for energy. It's uniquely immediate.
How immediate are we talking?
Well, think about it like this. If there's a shortage of semiconductor chips, it might take 6 months for laptops to get more expensive on a store shelf.
Right, there's a lag.
Exactly. But oil goes straight to the pump. The source data shows the national average for gasoline jumping from $2.92 to $3.84 a gallon.
Wow.
In a matter of weeks.
That is nearly a $1 increase practically overnight.
And the economic damage there is hyper-localized to people operating on strict budgets.
Because they have less wiggle room.
Exactly. When a family's weekly commuting costs jump by a third, that money's instantly drained from other areas of the economy.
Right. They cancel a streaming subscription or they skip a dinner out,
Or they delay buying new clothes. It is an immediate tax on discretionary spending.
which I guess pulls us directly into the broader economic fallout because energy costs don't just stay at the gas pump.
No, they bleed into everything.
Right. A massive spike in fuel bleeds into the cost of manufacturing steel, transporting groceries, powering industrial plants.
Everything gets more expensive.
So that oil shock instantly forces an inflation shock. But I see the employment data in our sources, and I really need you to connect the dots for me here.
Sure. What are the numbers?
Well, U.S. economic growth for the fourth quarter of 2025 slowed to an anemic 0.7%.
Which is very sluggish.
Yeah, and the economy just shed 92,000 jobs, pushing unemployment to 4.4%. So why does a spike in oil directly translate to a company deciding to lay people off?
It comes down to corporate margin compression.
Okay, break that down for me.
Basically, when a company's logistics and energy costs double unexpectedly, they usually cannot pass 100% of that cost onto the consumer.
Because if they do, nobody will buy their stuff.
Exactly, it would destroy the demand for their product. So they have to absorb some of that pain themselves.
Right.
And to protect their profit margins, they immediately freeze hiring, they cut contractor budgets, and eventually they eliminate full-time roles.
So the energy shock forces a contraction in the labor market.
Exactly. And the worst part is, while that contraction is happening, the cost of living is still climbing.
Yeah, the reports show the Federal Reserve just had to raise its 2026 PCE inflation forecast from 2.4% to 2.7%.
And PCE, personal consumption expenditures, is essentially the Fed's preferred dashboard, right?
Yeah, it tracks what consumers are actually paying for goods and services out in the real world.
So we are seeing growth evaporate just as inflation expectations are being revised upward.
Which is where the financial press starts screaming the word stagflation.
Oh yeah, everyone is using that word right now.
But I want to push back on that narrative a little bit, because Federal Reserve Chair Jerome Powell explicitly went on record saying that current conditions do not meet the threshold of true 1970s-style stagflation.
Right, he was very firm on that.
He actually called the underlying U.S. economy amazing. So are the markets completely overreacting to these reports, or is Powell just doing his job as a central banker and, trying to keep everyone calm?
Well, Powell is technically correct in his historical definition.
Okay.
We are not experiencing the double-digit inflation combined with systemic generational unemployment that really defined the 1970s.
Right, it's not that extreme yet.
However, downplaying the current data ignores the reality of the stagflationary standoff we are trapped in today.
A stagflationary standoff?
Yeah, it's the simultaneous combination of slowing growth and persistent, sticky inflation. It creates an absolute nightmare scenario for policymakers.
Because the usual mechanisms to fix one problem actively make the other problem worse.
Precisely. You can see how precarious this standoff is by contrasting the United States with Europe in our source material.
Yeah, let's look at Europe.
The U.S. has some structural advantages that are buffering the blow, but Europe is highly vulnerable to energy shocks.
Right, they rely a lot more on imports.
Exactly. The European Central Bank just slashed its growth estimates for the year to a microscopic 0.9%.
Wow, barely growing at all.
While simultaneously raising its inflation forecast at 2.6%.
It's the ultimate central banker's dilemma.
It really is. I mean, if a central bank raises interest rates to crush the inflation, they choke off that tiny remaining bit of growth and force a deep recession.
Right, which means more job losses.
Exactly. But if they lower rates to stimulate the economy and save those 92,000 lost jobs, they risk letting the energy-driven inflation run completely out of control.
You just can't win, which perfectly explains why the world's central banks have effectively frozen in place and why the equity markets are throwing an absolute tantrum right now.
Yeah, they really don't know what to do.
We are looking at a synchronized global pause. The Federal Reserve held rates steady at 3.50 to 3.75%. in an 11-to-1 vote.
Almost unanimous.
And the Bank of England held rates steady in a unanimous 9-to-0 vote, which our sources point out is their first unanimous vote in 4.5 years.
That is a huge signal.
The European Central Bank held, the Bank of Japan held. Everyone is just pausing.
Because the world's primary economic engines are paralyzed by this impossible choice.
It makes me think of a driver on a completely iced-over road.
Oh, that's a good way to look at it.
Right, you start sliding. If you hit the gas, which is the equivalent of cutting interest rates, you just spin the inflation tires and make the slide worse.
Yeah, you lose all traction.
But if you slam on the brakes, like hiking rates, you send the entire economy into a ditch.
Right.
So the central banks are taking their hands off the wheel and coasting, just hoping they don't hit a tree.
The structural metaphor holds up perfectly there. And the reason the stock market is reacting so violently to this coasting is that it destroys the core assumption investors have been relying on for months.
The evaporating rate cuts.
Exactly.
Yeah.
Prior to this geopolitical shock, the market was heavily betting on a rescue mission. Everyone expected multiple interest rate cuts throughout 2026.
Right, they thought help was on the way.
But now, the Fed's famous dot plot, the chart mapping out where individual officials think interest rates are heading, it shows only one singular 25 basis point rate cut expected for the entire year.
Just one cut.
Just one.
And the realization that help is not coming has caused absolute market carnage. I mean, the Dow lost 768 points in a single day.
Brutal.
The Russell 2000, which tracks smaller companies, entered official correction territory, down 10%. It's the longest losing streak for major indices in over a year.
Yeah, it's a massive sell-off.
But I want to dig into the mechanics of this with you. I understand that high rates generally hurt stocks, but why does it specifically crush massive tech companies like Microsoft more than, say, a boring established utility company?
That's a great question.
Like, what is the actual math connecting a central bank pause to a tech stock crash?
Okay, so it comes down to a financial concept called the discount rate, which is heavily tied to the time value of money.
The time value of money, right?
When an investor buys a share in a high-growth tech company, they are not primarily buying the profits the company is making today.
Because a lot of them aren't making that much profit today anyway.
Exactly. They are paying a premium for a claim on the massive profits that company is projected to make 5, 10, or 20 years in the future.
Okay, but $1 20 years from now isn't worth $1 today.
Precisely. Because of inflation and opportunity cost.
Yeah.
You have to discount that future money backward to figure out what it is realistically worth right now.
Got it.
And the interest rate set by the Federal Reserve acts as the foundational baseline for that mathematical discount rate. So when interest rates stay elevated, the formula shifts.
Right.
The higher the interest rate, the more aggressively you must discount those future earnings.
So the gravity of the financial universe just got much heavier for companies banking on the future.
That's exactly it. Overnight, the mathematical present value of their future profits shrinks, even if their actual software products or business models haven't changed at all.
That is fascinating. And the sources highlight this exact phenomenon playing out, right? Like the tech sector reevaluation.
Oh, absolutely. Look at Microsoft Azure, their massive cloud computing platform. It saw its growth slow to 39%.
Which is still huge. I mean, for almost any other business on Earth, 39% growth is a spectacular triumph.
Yeah, you'd be popping champagne. But for mega-cap tech, which is heavily reliant on future expansion to justify its stock price, it signals a slowdown.
Wow.
Across the board, the NASDAQ 100's earnings growth dropped from a staggering 35% down to under 15%.
So with interest rates staying higher for longer and economic growth decelerating, investors aren't just selling blindly. They are fundamentally rewiring their portfolios to survive the volatility.
Yes, we are witnessing a massive migration of capital.
The rotation out of speculative growth and into defensive posturing is unmistakable in these reports.
Because when investors can no longer rely on explosive future growth because of that discount rate math we just talked about, their priorities shift entirely.
They want cash in hand today.
Exactly.
Which perfectly explains the flight to dividends. Our reports show that the S&P 500 dividend aristocrats, and these are companies with a long, proven history of paying and consistently growing their dividends, they saw their earnings growth actually rebound to positive 9%.
It's a textbook survival strategy during a period of macroeconomic uncertainty. Investors are seeking shelter in boring, defensive, cash-generating businesses that pay them simply for holding the stock.
But it isn't just the public stock market feeling the squeeze here. The reports dedicate significant space to the cracks forming in private markets, too.
Yeah, that part is particularly concerning.
They highlight what they call a yellow warning in private credit. Massive institutional players like BlackRock, Morgan Stanley, and Blackstone are actually implementing redemption limits on their private credit funds.
The situation in private credit is honestly one of the most critical structural risks highlighted in these documents.
Why is that?
Well, following the 2008 financial crisis, heavy regulations pushed a lot of corporate lending out of traditional banks and into the private market. So for a decade, in a zero-interest rate environment, investors chased higher yields by pouring money into these private credit funds, which lend directly to companies.
But because those loans aren't publicly traded on an exchange, they're highly illiquid, right?
Right. You can't just click a button and sell a private corporate loan the way you can sell a share of Apple.
No.
So when a geopolitical shock hits and the broader market panics, institutional investors run to these private funds and demand their capital back.
But the funds don't have billions in cash sitting in a vault.
Exactly. The capital is locked up in active loans to mid-sized companies. So to prevent a catastrophic collapse, the fund managers are forced to put up gates.
They implement redemption limits.
Yes. They effectively tell investors, you are legally restricted from withdrawing your money right now.
I can only imagine the absolute panic that causes for an institutional investor who desperately needs liquidity.
Oh, it's terrifying for them.
But this brings me to a really fascinating paradox in the data.
Okay, let's hear it.
We are talking about a world dealing with an active conflict, severe supply chain blockages, inflation spikes, and equity market crashes.
All at once.
Right. So in every historical playbook, shouldn't gold, the ultimate safe haven asset, be skyrocketing?
You would think so, yes.
Instead, our sources show gold is down 5% and silver is down a massive 10%. Why are precious metals selling off so hard in the exact environment they were designed to protect against?
It is a brilliant anomaly.
Yeah.
And it occurs during almost every severe, sudden liquidity crunch.
Really?
Yeah. When institutional investors and hedge funds experience steep, sudden drops in the equity markets combined with severe inflation fears, they often face margin calls from their prime brokers.
Ah, margin calls.
Yeah. So the bank calls the hedge fund and says, the investments you bought with borrowed money are tanking, your collateral is insufficient, and you owe us cash today.
Today, not tomorrow.
Exactly. So they need to raise cash immediately to cover those massive losses.
Mm-hmm.
But they cannot sell their private credit holdings because BlackRock and Blackstone just gated the funds.
Right.
And their tech stocks are bleeding value by the minute.
So what do they sell?
They sell their winners, they sell the assets that have held their value, and crucially, are highly liquid. They sell their gold.
So they aren't selling gold because they stopped believing it's a safe haven.
Not at all.
They're selling gold because it is literally the only thing they can sell to raise the cash needed to save the rest of their burning portfolio.
Exactly. It is a pure liquidity cascade. You sell what you can, not what you want.
Wow.
And connecting this back to you listening, it provides a masterclass in how modern portfolios actually behave under extreme stress.
Yeah, because you might look at your asset allocation and think you are perfectly diversified.
Right, but during a true macroeconomic shock, correlations often go to 1. Everything gets sold indiscriminately just to raise cash. Understanding what you hold is just as important as understanding why you hold it.
That is such a crucial point, and putting all these pieces together really highlights the sheer interconnectedness of the system.
All linked.
Right, like a geopolitical conflict in the Middle East traps 150 ships in the Strait of Hormuz. That physical supply chain blockage spikes Brent crude oil to $112 a barrel.
Yeah.
That energy shock bleeds into corporate logistics, forcing margin compression that kills 92,000 U.S. jobs, while simultaneously driving inflation expectations to 2.7%.
A vicious cycle.
And faced with that stagflationary reality, central banks freeze, canceling planned rate cuts. And because rates stay high, the math of the discount rate crushes the future value of tech stocks, forcing investors to dump growth for dividend-paying safe havens, triggering a wave of margin calls that drags down even gold and silver.
A physical bottleneck in one hemisphere dictates the valuation of a software company in another. The global economy is just a single, highly sensitive organism.
It really is. Now, before we wrap up this deep dive, I want to leave you with a final thought to mull over.
It's a big one.
Yeah, it's something buried deep in these reports that points toward the next massive structural challenge. The data noted that despite the slowing growth and the tech sector reevaluation, massive spending on artificial intelligence infrastructure is actually one of the only things anchoring U.S. economic activity right now.
Yeah, which is wild to think about.
Right. Building data centers and expanding the grid is single-handedly propping up parts of the economy. But AI data centers require unprecedented, staggering amounts of electricity to function.
And we are simultaneously entering a severe geopolitically driven energy crisis.
Exactly. So here's the question for you to explore on your own. If this energy crisis deepens and the physical supply of oil and gas remains constrained, what happens when the unstoppable force of the AI investment boom collides with the immovable object of a global energy shortage?
It's a huge collision course.
Right. Can the digital economy actually continue to grow if the physical world simply cannot afford to power it?
I think the tension between the digital future and physical energy realities will define the next economic chapter.
We want to thank you for joining us on this deep dive. Navigating these reports can feel overwhelming, especially when the data directly impacts your financial well being. But understanding the mechanisms driving the volatility is the best way to survive it. Stay curious and keep seeking the why behind the headlines.